Inflation numbers out just a short while ago show a steeper than expected fall in the consumer price index last month to just 3.7%. The market had been expecting CPI to reach 4% after falling to 4.2% the month before. Joining me with more is Sheshi Kaniki. He's Senior Economist at Momentum. Sheshi, thanks very much for coming in this afternoon.
Thank you for having me.
And Sheshi, this seems to be a pattern that we've seen over the past few readings for CPI, where it has come in lower than expectations, this time quite significantly below that. Why do you think we're seeing this continual pattern?
Well, I think first of all to say this is very good news for consumers. I think the relief that this brings is very welcome at a time such as this. I think the reason why we are seeing inflation go down is we are still in an environment where not only the local economy but globally we have a very protracted growth recovery. It's very slow, it's very tentative, and that will reflect in inflation because there's a clear link. If the economy was growing faster and the recovery was more robust, we would see inflation not going down the way it is.
Do you think this is a temporary respite though, because many have been saying we're going to see that inflation spike at some point, particularly when we see all of these electricity price increases filtering through?
Well, we haven't seen that coming through yet. So we had the PPI figure last month coming in at, for June, coming in at 9.2 or so, and one would have thought that it could have come through now. But I think that link has not yet fed itself through, and we are very comfortably within the inflation target of 3 to 6% that the Reserve Bank holds to. And given the global estimates and local estimates for recovery, I don't think that there is a real danger of inflation spiking in the near future.
Any chances of us reaching the bottom end of that target, maybe getting down to 3%?
To be honest, at this stage, I think it's anybody's guess because what we have seen is lower than anticipated falls right from the beginning of the year, and we're now moving towards September. So it's anybody's guess at this time. I would say, given what's happening globally, we cannot discount that altogether.
Of course, we had growth figures out yesterday, 3.2%, and that was significantly worse than the market was looking for. They were looking for a figure of about 3.6% from 4.6% in the first quarter. Looking at the combination of growth here, very benign inflation at this stage, what do you think the MPC is going to say when it wraps up that meeting next month?
Well, I think several analysts have been saying for some time now that we have real room for another interest rate cut, and I think the inflation figure that's come out today gives further support to that position. I think that the growth figure, though lower than what the market was anticipating, what analysts were anticipating, is still, a respectable figure, and I think on its own would probably not suggest that the Monetary Policy Committee will cut interest rates. But in light of what's happening globally, in light of the fact that inflation is lower, and all things taken together, I think there is definitely scope for another interest rate cut.
And of course, the Reserve Bank Governor Jill Marcus has clearly said on a number of occasions that they are watching with concern what is playing out in the developed world, particularly in the United States and Europe. So that's going to be something that's going to feature going into the next meeting as well, isn't it? Absolutely.
We have to keep an eye on that. I think the sovereign debt problem has become probably more of a risk now than what it was maybe 3-6 months ago, and we must keep a very close eye on that. What it has done is it has affected global risk appetite, has affected global investor confidence, and it has meant that even our GDP figure for next year will actually be lower in terms of what has been forecast by people like the IMF than what we've enjoyed this year. So the recovery much, much slower than what we anticipated.
Sheshi, do you think the slowdown in the economy, and we knew it was going to slow down from that 4.6% in the first quarter, do you think it's come a quarter too early? Because that's what some economists are saying, that they hadn't expected the extent of the slowdown to filter through so soon.
Well, I'm not sure really, because if one looks at the sectors that did well, you've got the finance sector did well, retail did well. We had a good bounce in manufacturing, which year on year grew in excess of 7%. That's very, very positive. So I would say, it probably came at a time unexpected because we're expecting that the World Cup would have given perhaps more of a windfall. But I think it's very much in line with what's happening globally. The US, Japan, they've all been giving similar type of figures, and we are so much linked to the global economy that it's not totally unexpected.
Just looking at the manufacturing sector, though, and you pointed to that 7% growth that we saw in the second quarter, We have had PMI readings out for June and for July, and in fact in June the PMI dipped below 50, which is the break-even level which separates contraction and expansion. Would you expect manufacturing to come off significantly if it does follow that lead indicator from PMI?
The thing with manufacturing is we've got to realize that our manufacturing sector services not only what's happening domestically, but there's also a big component of our manufacturing goods which are exported. So again, there comes that link with what's happening internationally. And it's good that we've diversified. We're trading much more now with countries like China, which are still growing well. So I think if we can provide further stimulus domestically to support that manufacturing growth, and that could come through an interest rate cut, for instance, I think then we would have further support and a more sustained recovery in that manufacturing sector.
Could that further stimulus for the manufacturing sector perhaps come from weakening the rand? Of course, we know that the ANC's policy conference is going to be looking at the rand next month. There's been all sorts of suggestions of what it could do to try and weaken the rand. So weaker rand might help our manufacturing sector going forward, but then that would also put a spoke in the wheels of inflation going forward.
Yes, there's always this positive and negative, and this thing that we need to do in terms of weighing those pros and cons. But yes, the rand is fairly strong at the moment, and in a sense that has actually probably been good for our inflation figure today, because our imported inflation would have been subdued by the fact that we are cushioned by this strong rand. But yes, any stimulus that we can give to the manufacturing sector through a weaker rand, and again a weaker rand can come through a lower interest rate, because if we look at the interest rate spread between South Africa and the developed world, it's extremely high, and it's not something that is unexpected, that we've got massive capital flows looking for yield in South Africa, and that's causing this increase in the value of our rand.
Of course, with CPI at 3.7%, the real repo rate is effectively only about 2.8% at this stage. So it gives them a little bit of scope for cutting. Do you think if we get a cut in September, it could be followed by another cut in November? What's your feeling? What are they going to do?
Well, I think it would be great if we could start with a cut in September and then take it from there. Your point around real interest rates is very, very important, because we do have an important constituent in our country, for instance, who live off savings, so like our pensioners, our retirees, and their income comes from the fact that they can get a return from their savings and from interest rates, and if those go too low and they get a negative interest rate, it affects the amount of money that they have to live on. It also can be a disincentive to new savers. But this low interest rate environment, low inflation environment rather, is good for saving and real saving, even in an environment where interest rate can be slightly lower.
Sheshi, we have to leave it there. Thank you very much for your insight.